Hello investors! Welcome to the channel where I talk about investing for the long term through investing in companies that pay a dividend. This is known as dividend growth investing. My name is Michael, and today we're going to start off with looking at how the market ended for the week and then look at stock futures. Just taking a quick look at the major indices for the week. For the S&P 500 index, it is up 0.61%. For the Nasdaq index, it is up 0.10%. And lastly, for the Dow Jones Index, it is up 1.79%. The markets are experiencing a lot of volatility this week and overall ended up slightly better than how it started. Now, let's take a look at the news affecting the overall market. So, as everyone should be aware, the main culprit for driving down the stock market and its volatility has been news of the COVID-19 virus continuing to spread at a rapid rate. As of this recording, 223 confirmed cases and 12 deaths by COVID-19 have been identified in the US. While it may appear that the cases for COVID-19 disease are massively escalating, in reality, it's just that now we're starting to test for the disease. To combat fears of COVID-19, the central bank has cut interest rates by 0.5%, making it the biggest single cut in more than a decade. As it currently stands, the federal funds rate is lowered to range between 1% to 1.25%. The reason behind the rate cut is to keep the U.S. economy strong in face of risks by COVID-19 for the economic outlook. Now, generally, when interest rates are cut, it makes borrowing money a lot easier because the interest rate that's compounded on the borrowed money is less. This lowering of interest rates makes it easier to borrow money through loans to purchase things such as houses and cars. So right now, and the foreseeable future, it may be a good idea to borrow money through refinancing mortgages or taking auto loans since interest rates are really low. As we can see here, this is how the market reacted to emergency rate cuts over the past decade or so. So according to this infographic, the responses to federal rate cuts has been pretty mixed. Generally, the whole purpose of it is to lower interest rates so that spending occurs through borrowing money. However, this is not the case with COVID-19. During the recession, the funds rate has been nearly close to zero. And generally, it would hover around anywhere between 4 and 6% for the federal funds rate. But right now, we're looking at about 1%, which is right here. So there is room for the federal funds rate to decrease even further. However, this is really risky because this makes it really easy for people to borrow money and not having to pay it back, leaving people into more and more debt. In other news, COVID-19 testing kits are in short supply. Several states, doctors, and patients are complaining that access to testing kits for COVID-19 were high barriers to access. As the number of COVID-19 cases continues to grow, it becomes further frustrating knowing that the complacency and slow action by the federal government creates a situation in which it is difficult to beat and fight back against the COVID-19 epidemic. These testing kits for COVID-19 are important because the symptoms for COVID-19 are extremely common in other cold or flu-like diseases. For now, people who are experiencing COVID-19 symptoms should perhaps think that it is wise to be quarantined and contain them from spreading the virus even further. As we can see here, in California, there were thousands of people being monitored for the virus, yet only 516 test kits were used to conduct these individuals. Health officials have stated that in New York, the number of cases of people who have COVID-19 have quadrupled in this week alone, and they are in need of more assistance to identify this disease and also make testing so that a cure can be created. Now, moving on to the consumer side of things, Wholesale stores like Costco are benefiting extremely from the COVID-19 disease. As Costco members flock to the wholesale store to clean out the warehouse of basic necessities such as water, toiletries, and canned goods, the sales and consumer demand for Costco are spiking up quite nicely. However, at the rate the demand for wholesale good items is going, it may be detrimental if supply runs low and people are left with little to nothing to sustain themselves. This COVID-19 epidemic is a good reminder of how we should always be prepared in cases of emergencies rather than panic at the last moment. Now let's talk about some investing news. This past week, the Robinhood trading application shut down for 2 days in a row, losing a lot of money during the largest economic recovery since 2009. As a result of Robinhood being offline, many investors have left the platform as they watch their portfolios drop further in value rather than recover. To understand this, the S&P 500 index rose 4.6% in value, which represented $1.1 trillion on Monday and Tuesday. To make matters worse, traders lost a significant amount of money because they couldn't control their calls or put options. For a company, Robinhood, which was funded $1 billion, to be unable to have the correct infrastructure to be in place for trades to occur is simply unacceptable. Now, for people who still have Robinhood accounts and want to transfer to a different brokerage, such as M1 Finance, this is how you do it. You need to request an ACAT, which is an acronym for an Automated Customer Account Transfer Service, costing you $75. This service will move all of your stocks from Robinhood to another brokerage, like M1 Finance. Now, to avoid this $75 fee from Robinhood, I suggest you reach out to the competitive brokerage through their messaging support system and ask if they can cover the $75 transfer fee for you, which I guarantee they will most likely cover because it only helps out their business. If you do consider opening an account with M1 Finance in order to transfer your money from Robinhood, then I will leave my affiliate link below to M1 Finance for you to sign up and earn $10. Now, speaking about M1 Finance, let's move onward to my portfolio to see how it's been doing for this week. So looking at the past year, my portfolio is down 12.38%, causing a loss of about $480. Looking at the past quarter, my portfolio is down 13.42%, causing a loss of about $990. Looking at the past month, my portfolio is down 11.65%, causing a loss of about $1,130. Looking at the past week, my portfolio is actually up 0.22%, causing a gain of about $20. And finally, looking at the past day, my portfolio is down 1.84%, causing a loss of about $175. So wow, that's still a lot of red to stomach, but there is hope that this portfolio will rebound with the market and perhaps even outperforming it. However, if you look at this right here under all of the time lapse, my dividends earned is still here. We can look at all of them and it will show you that my earned dividends is still here. So even during this week, this entire month, when the market is down, I'm still earning dividends from all of these companies that I hold. This earned dividends number is the reason for this kind of investing. When there are market downturns, this earned dividends number continues to go up regardless of what happens. And the only reason this number would ever stop from moving upward is if all the companies that I invest in suddenly stop paying a dividend. This is why it's so important to do dividend investing, is when times like this happens, when the market is volatile or the market is going downward. You don't have to worry so much about losing money on a ledger-like style, because in the background, all the companies that you are invested in are paying you for holding a share in their company. And right now, it's a really good time to invest in any of these companies, especially in the consumer defensive portion of the economic market, because a lot of people are going into places such as Costco or Clorox or Procter & Gamble or even Walmart. They're going into these companies which will be around for a very long time because they provide basic necessities. And it's through these necessities that you can hold with a heavy heart, knowing that even if the market goes down, safe companies such as these right here will always go up and try to balance your portfolio. Now, in addition to this week, I also earned a decent amount of dividends from various companies, which I can use to reinvest into my portfolio. Taking a look at down here, I earned 7 cents from First Energy Corp, 18 cents from Wells Fargo, 20 cents from WW Granger, 12 cents from Intel, 3 cents from SJW Group, 86 cents from J.M. Smucker Company, 13 cents from Trust Financial Corporation, 10 cents from WEC Energy Group, 3 cents from Skyworks Solutions, 8 cents from Visa, 3 cents from American Waterworks Company, 71 cents from Valero Energy Corporation, $1.03 from Archer Daniels Midland Company, 16 cents from Amgen, 94 cents from Boeing, 4 cents from Cable One, 12 cents from Honeywell International, 4 cents from Parker Hannifin Corporation, $1.12 from Pfizer, and 9 cents from Southern Company. All these dividends that I earned are a result of me owning shares of each company. This is money that I did not have to put any effort into earning, besides clicking a few buttons to buy shares. Essentially, I'm earning money while I sleep. This is referred to passive income, earnings which are derived from an enterprise like a rental property or a company which require little to no effort to earn and maintain. Although these amounts may seem small, every little bit helps and will eventually snowball into something bigger through compounded interest. This concludes the update portion of my portfolio. Thank you so much for watching this video until the end. If you liked the video, then please give it a thumbs up, as it will help the channel grow immensely. If you have any comments or questions, then please leave them down below in the video, and I'll do my best to personally address it either in the comments or answer it in future videos. I greatly appreciate everyone watching my videos, and I hope to speak with you all again very soon.